Ladies and gentlemen, friends and colleagues, welcome. I'm George Skiadopoulos, Director of the Institute of Finance and Financial Regulation. Welcome to the third conference on ESG for banks, corporates, and institutional investors. The conference is co-organized by the Institute of Finance and Financial Regulation and EBRD. We are going to have a rich 4 hours, I guess, ahead of us, and we're going to address timely topics of importance for corporates, banks, institutional investors, regulators, and policymakers. We're going to be informed by high-quality speakers on the latest developments in the field, but we are also going to address certain challenges. So, before giving the floor to Andreea Moraru for opening remarks, Andreea is the Regional Director of EBRD for Greece and Cyprus. Let me briefly inform you on the format of the conference. So we're going to have sessions where the speakers are going to deliver presentations. And following these presentations, the audience will have the opportunity to interact with the speakers via Q&A. So feel free to submit any questions you may have. There is an Ask area next to the stream where you can submit your questions. We are also going to have 2 roundtable discussions, as well as a fire chat discussion and a solo presentation from both professionals and academics. I would like to thank EBRD for the wonderful cooperation we have over the past 3 years, and especially Andreea Moraru and Olga Aristidou. I would like also to thank the IFFR sponsors, in particular, the Platinum sponsor, EY, Ernst & Young, our Gold sponsors, Synergy Holdings, Grant Thornton, National Bank of Greece, and Piraeus Bank, our affiliate organization, Prodea Investments, our supporter, Athens Exchange Group, our media partners, the Athens Macedonia News Agency, Capital GR, Euro Today, Next Deal, and Responsible Investor. I would also like to thank Eventora, Hartis, Saint Lavi, the IFFR team, in particular, Stelios Kondarinis, Maria Giuli, Thomas Giuli, Christina Rutiman, Despina Kodopoulou, Fotini Trapalis, Athina Hadjigianni, and many others who have assisted us through this journey. Finally, I would like to thank the University of Piraeus, and in particular the Department of Banking and Financial Management, under the auspices of which IFFR is running for the past 5 years now. Finally, may I also remind you to visit the digital booths if you wish, and also fill in the questionnaire that it is going to be distributed to you via link throughout the conference. So without further delay, may I pass the floor actually, to Andreea Moraru, the Regional Head Director of Greece and Cyprus. Andreea, the floor is yours. Thank you.
Thank you. Thank you very much, George, and good afternoon, everyone. I am very happy to participate again this year at the ESG conference for banks, firms, and institutional investors. As most of you are aware, sustainable development and environmentally sound investments are at the heart of EBRD's mandate since its inception in 1991. In 2021, under our green economy transition approach, we committed to dedicate at least 50% of our annual business volume to green investments by 2025. We have achieved these objectives already in both 2021 and 2022. In Greece, 55% of our investments last year have been directed to green projects. Since the beginning of the year, together with the European Investment Bank, we have become the first MDB to align all our activities with the goal of the Paris Agreement, including limiting the temperature increase to 1.5 degrees Celsius. As we include a climate lens in all our investments through Paris Agreement alignment, we'd like to take our clients in this journey too. There is an urgent need for a more holistic and extensive policy reform support for clients. And as a development bank that focuses on the private sector, one of our key priorities is helping companies to transition to a low carbon culture. Our corporate climate governance program provides this much needed support by enabling our clients to assess, manage, and incorporate climate consideration into their governance, strategy, and risk management structures, and strengthen their climate-related disclosure practices. Under the CSG program, we are working closely with boards and senior management from our 300 partner financial institutions and the wider client base across the region. As we continue to innovate, we are keen to expand where possible from a project-by-project approach to a country-led approach that combines the right ingredients for a system-wide transition. This would include climate planning, conductive regulatory frameworks, mobilization of public and private finance, and technical assistance. Financial intermediaries are crucial to deliver on Paris. To assess Paris alignment for the financial intermediaries, we intend to move over time from a transaction-based approach, relying on the assessment EBRD use of proceeds to finance specific sub-transactions, to a counterparty-based approach, aimed at transforming the climate-related business practices of EBRD financial intermediaries. This will rely on counterparty assessment of climate-related business practices, following on the development of a transition plan, setting time-bound milestones for the financial intermediaries to ensure they are credible, aligning their financial flows. Going forward, we'd expect our clients, the financial intermediaries, to commit to align their financial flows with the goal of the Paris Agreement and to prepare a transition plan, assess the current level of their climate practices, prepare a transition plan within 2 years of signing a financing agreement with EBRD, implement a transition plan in line with the milestone and goals they have set out, and disclose the core elements of this plan. We'll support our clients in preparing and implementation of these transition plans. The bank will help them assess the current climate practices and identify areas for improvement to understand the elements on which their transition planning should focus. The EBRD Corporate Climate Governance Facility will provide financial intermediaries with support in specific areas through dedicated advisory services or tools presenting best practices. The bank expects the majority of the new transactions to be assessed for Paris alignment under its counterparty-based approach within 4 years for the start of the Paris alignment commitment. But where we are in Greece on the green agenda? In EBRD, we started to invest in Greece in 2015 to support reforms and return to economic growth. We have moved since then quickly to establish a significant presence on the ground in Greece, and today to invested more than 6.6 billion in 102 projects. Our strategic priorities include 3 overarching priorities: strengthening competitiveness by facilitating the expansion of the private sector, supporting sustainable energy and infrastructure, further enhancing the resilience of the financial sector. The advent of the pandemic, as well as the war in Ukraine, undoubtedly required the inclusion of additional measures to support the economic recovery in an environment of high inflation, tightened monetary in response, and silent capital markets. Priorities for the green agenda in Greece include support greater energy and resource efficiency, including green and sustainable buildings, climate resilience, and decarbonization across sectors through direct engagement with private clients. Facilitate expansion of renewable energy, focusing on market-based support measures and projects with corporate PPAs. Financing of largely private-led generation and distribution projects, which are critical for the timely role of the renewable projects. Targeted advisory and investments in support of the government's decarbonization commitment, including appropriate legal and regulatory frameworks and other measures to improve the energy mix, as well as related social economic aspects to assist coal-affected regions in transitioning to a new economic model in line with Greece's just transition agenda. Since 2016, we have invested more than 1.5 billion euro in Greece into 70 green projects. Projects under this portfolio are estimated to reduce 2,009 kilotons CO2 per year, equivalent to over 3.9% of Greece's total carbon dioxide emissions in 2020, or equivalent to removing 1.1 million cars from the road. 2021 and 2022 were record years with 781 green financing and 29 project sites. Reflecting our mandate and operating model, 93% of the projects have been private sector focused. Actually, now our portfolio is 100% private sector. On average, green financing represented about 32% of the total annual investment, and in 2021 and 2022, as mentioned earlier, it went above 50%. Some highlights green investments over the last few years. We invested 150 million in MREL eligible instruments issued by Alpha Bank, NBG, Eurobank, and Piraeus, supporting banks building resilience and secure regulatory compliance. We supported Greece digital transition with 150 million investment in OTE, consisted of a 56 million tranche provided by EBRD and 93 million tranche provided by the Recovery and Resilience Facility. The second operation we supported with a 10 million loan, Rajgopal, also a facility under the Recovery and Resilience Facility that supported the company to make green investments. We also supported Papuchanis, a small and medium-sized company with strong export activity with a 12 million loan. Again, this has been part of the EBRD and RRF co-financing facility. We have provided an additional 50 million equity commitment to the bank's existing joint venture with Demand, a leading Greek real estate development with a wide track record in delivering major brownfield redevelopment and regeneration project in Greece. We also invested in Lambda, a debut green bond issuance, 20 million. And also we supported the Piraeus Bank with we invested 10 million in the synthetic securitizations, quite a novel instrument for the green market. All these projects that I mentioned have a green component attached to the EBRD use of proceeds. In the last couple of years in Greece, we have witnessed shift of focus by our clients towards more sustainable investments, and this is very encouraging. And we are very proud to be part of this journey of our clients. Both investors and users realize more and more that green investments encompassing climate resilience technique extend both the lifetime of the assets and make them more resilient. ESG performance is increasingly used by stakeholders to draw conclusions about the quality of the management in identifying exposures to business risk and leveraging business opportunities. Therefore, it is becoming more and more important for companies to communicate with investors clearly and accurately on these aspects. There is a growing evidence that companies that publish high-quality information on the longer-term implications of ESG in their business are more likely to attract long-term investors and reduce their cost of capital or increase their ability to finance sustainable projects. As a final note, I should mention that we plan to do more and more green investments projects in Greece in the years to come. I really hope that this event will stimulate the dialogue between EBRD, financial intermediaries, and policymakers. Events like this are very important for us as a bank, as a means of identifying how and where we can best focus our support to further push the ESG agenda, both in terms of investment and technical supports. So big thanks to the organizer for organizing again this event this year. Thank you very much.
Thank you, Andreea. Thank you very much for the collaboration. So now we're ready to proceed to the first session of the conference, which has to do with ESG benefits and challenges. The session is going to be chaired by Mr. Panos Dasmanoglou, a very high quality moderator, a C-class executive. Mr. Dasmanoglou has held various positions in various executive boards. Currently, he is serving as the Executive General Manager of Group Compliance and Corporate Governance at the National Bank of Greece. And he's also the General Company Secretary at the National Bank of Greece. He has been involved with various Euroforums in forums, including the European Banking Federation. Mr. Dasmanoglou, the floor is yours.
Dear Mr. Skiadopoulos, dear ladies and gentlemen, thank you very much for this honor to be chair in this important, very important session. A warm welcome to all of you, and many thanks to the Institute of the Finance and Financial Regulation and the EBRD for organizing this event. Without a doubt, the future of ESG is fully loaded with challenges and benefits. ESG are strictly related with the future of our work, the future of our economy, and the future of our lives. Especially in the financial sector, many compliance, I think, as issues and many challenges. Just to mention a few: ESG data, ESG a way of thinking in a boardroom. As you know, ESG is already one of the critical suitability criteria of ECB for the board members. Okay, something that is crucial. ESG risk management and leadership, and finally, I think a question: how much I think regulation, ESG regulation, do we need in the future? So all these questions, I think, will be answered by distinguished professionals at the session. And the first as a speaker is the famous Professor Shivaram Rajgopal from Columbia Business School. Mr. Rajgopal is an expert in ESG and in accounting. He's a professor in accounting. His work covers a wide range of issues in the financial reporting, in the fiscal responsibility, and in the governance. I think his work is frequently cited in the press, including the Wall Street Journal, the New York Times, with Bloomberg, Business Week, and The Economist. So, Professor, I think, okay, the floor is yours. So welcome.
Hi, Panos, can you hear me?
Yes, yes, I hear you very well.
Very good. Just a quick programming note. First of all, thank you for having me. How much time do I have so that I can accordingly plan my comments and then leave some time for questions and answers? 1 hour, 40 minutes?
Shiva, you have 15 minutes, and then the other two speakers are going to step in, and then you will have, the three of you, 15 minutes overall for Q&A.
Okay, no problem. Can you see my slides?
Yes, we can.
You can see my slides. Okay, so thank you. Since I have 15 minutes, let me, as you know, this is a huge topic with lots of interesting implications, and it's a fascinating topic. So I'm just basically going to use 3 slides to get the conversation going. Hopefully we can, give me a second to make sure that the slides actually work because it's a bit slow here. And I'm going to lay out perhaps something that's less relevant to many of you, but it's still important, the highly contentious political debate in the US about the role of ESG. So I'm going to basically argue that both sides in this debate have effectively overstated their positions. And then towards the end, I'm going to maybe suggest why ESG is important to think about. Now, we can talk about financed emissions, we can talk about anything you want that may be relevant to you in the banking space, but I think the conceptual discussion is important to have. For some reason, I'm not able to make this full screen, but hopefully you can see what I'm doing, and I'm happy to share my slides later. Okay, so let's talk about the anti-ESG people. Mostly Republican, attorney generals and politicians in the US who have made several claims. And I don't have the time to kind of go through every claim they've made, but it's interesting for you to just glance over some of these or touch on a few. And I think, some of the claims, as you can see, at least, they seem a little absurd to me. The idea that, cost of capital for oil and gas firms is higher because of ESG. I mean, at least post-Ukraine, that's pretty hard to buy because oil and gas firms are, flush with capital. In fact, they're buying back stock. So capital is not really their concern. And in any case, measuring cost of equity capital is incredibly difficult. If you're talking about cost of debt capital, maybe for smaller oil and gas firms, maybe there is a little bit, I don't know. But in general, it seems to be a bit of a stretch to argue that cost of capital in general has become much higher because of ESG. Several other arguably absurd claims have been made that, ESG should be banned and so on. That's ridiculous because, at one level, it's an organic movement. If investors want to use USG, they can. If they lose money because of that, they can. That's a separate conversation. Lot of the, if you read the Wall Street Journal, of late, many of these, op-eds in the Wall Street Journal will argue that ESG is responsible for something, fill in the blank, whatever you don't like. And if you read the article carefully, a lot of the complaints are about ESG ratings or ESG scores. I don't even want to call them ratings because they almost seem to give them a sense of pseudo precision. If you look at the black box behind how these ratings are constructed, you can't call them ratings. They're at best scores, and even that is kind of sketchy. So if your complaint is about ESG ratings and scores, I 100% agree and understand that they need a lot of improvement, and they need to be worked on. Other arguments that are made: the shareholder capital is being wasted and used to support political or social causes that investors and employees don't have any interest in. That is, and that's the biggest comment or the biggest pushback that this movement has received. And I would counter argue, if that is indeed true, what are the boards doing? And aren't most of the boards, Republican, quote unquote Republican in any case? Maybe a benign counter hypothesis is that, maybe your customer base is changing. Many of the employees are increasingly young. A lot of them are highly skilled college graduates who are perhaps politically left of center anyway. So, in an effort to keep your customers and your employees happy, perhaps CEOs are doing the things that they are doing, could be a counter hypothesis. And finally, in the interest of time, I can keep moving on, the so-called Damodaran critic. This is my distinguished colleague from our neighboring school, New York University, NYU. And he's asked 4 questions. What is ESG? How does it affect firm value? As an investor, can you make money investing on ESG? And is society better off with ESG? So I'll hold off because, when I talk about my last slide on this issue. But the big point, why does society need ESG, is something I want to come and spend, quite a bit of time later at the, in this issue. So now let's quickly take a look at the other side, right? The other side, the pro ESG side, and even the pro ESG side, in my mind, has made many comments that are oversold. I mean, claims that ESG will save the world. I mean, certainly not. It's basically a way of investing. Perhaps people have pushed this idea that ESG can save the world as a marketing device to get more assets under management, to increase fees, which, I'm sure that's happened. Most of us know this. And then, the debate then becomes a critique about capitalism in general. People who push ESG, some of them basically don't like capitalism as practiced today. There is something to that. I mean, they'll say things like activist investing, hedge funds are short-termist, they affect sustainability goals. Boards with employee representation work better, as in Germany and certain parts of Europe, which we don't have in the US, as you know. And the last comment there, I think, deserves some discussion. It's a long comment, but let me read it out to you. It basically says, decades of focus on shareholders has only brought low employment, low engagement scores. Unions are in decline in the US, low levels of investment in retraining, a decline in R&D. levels of inequality similar to Argentina, communities fractured by lack of economic opportunity. This effectively captures, I think, the sentiment in Europe as well to some extent. What have we done with outsourcing? What has globalization really done for anybody? How has technology changed the bargaining position between labor and capital and society in general? These are very deep questions which need to be discussed carefully and thought about. I'm not sure ESG, in some sense, this is the root cause perhaps for the emergence of the ESG movement. So instead of dismissing this comment, I think we all need to grapple and debate with this. And this brings me back to the final slide, final positive message with which I want to leave you with, is all these are conversations about a firm's role in society. If your complaint is about ESG scores, ESG measurement, ESG reporting, I 100% understand those things are a mess. But that should not detract us from thinking about the bigger point, which is, what is the firm's role in society? Politics and the company have become inextricably interlinked. So one has to worry about, what is the company getting from society and what is it giving back? And, since Panos mentioned I'm an accounting professor, so let me frame the conversation as I see it in an accounting light, give you some ideas and stop, and hopefully have a discussion with the audience. The first big point, if you remember, in an income statement of a firm, we set the cost of natural capital to be zero. What does natural capital mean? It means water, it means soil, it means land, it means mining resources. I don't know how to value natural capital, but setting it to zero doesn't seem like sensible to me. I'll give you examples. For example, Coca-Cola. There are reports that it extracts water in areas where the local communities don't have water to extract. Are you paying the full price for that water? I'm not sure. The second big point is that our reporting model completely ignores, in my mind, both positive and negative externalities. And let's also focus on the positive. By that, I mean, imagine Zoom or Teams or whatever we are using for this conference. This would be impossible without Zoom or Microsoft software. How much are we paying for using this package? $100, $200, $1,000 a year, nothing. But the value that these packages add to our lives and to make these conversations possible is immensely high. So that's the positive externality that companies create that we sometimes ignore, we completely ignore in our conversations and in our reporting. And of course, there's been lots of conversations about negative externalities. That. Starbucks probably generates, I don't know, they say 7,000, 8,000 unrecycled, paper and plastic cups a day. Coca-Cola is the biggest producer of unrecycled plastic in the world, etc. We know about that, the negative externality idea. And finally, I saw Andrew Ang was on the panel from BlackRock, and I'm going to argue that passive indexing, has, I think, made matters worse in the sense that the link between who actually supplies capital, which is the person in the pension fund, the 401k, 403b, as we call in the US, and the CFO or the CEO of Apple or Microsoft who gets the capital. Where is the link? It's become very disconnected because of passive indexing, in my view. As a result, we don't ask enough questions about managerial accountability. You give a manager shareholder capital, natural capital, human capital, what have you done for society in terms of taxes and subsidies? You don't have much of a discussion anymore the way we used to back in the 90s. So I think that's the other potential problem in this debate. So how do you solve this? Just making one final point. Most income statements typically, as you know, have revenues, materials, labor, capacity costs, R&D, taxes. I suggest that, you almost need value add statements for each of these stakeholders. For example, consider one such idea, employee value add. You're working for Apple computers, you get $150,000 as a salary. Your next best alternative is to work for someone else, but you would get only $125,000. So 25,000, 150 minus 125 is the value that Apple adds to the employee. And you can create similar such ideas. You can create a customer value add. You can create, a supplier value add. You can create citizen value add in terms of taxes that you're paying to the government and the subsidies and the other grants that you're getting. So I think a broader way of thinking about what the firm contributes to society can make a huge contribution to this social and political debate. So that's why I think ESG is an exciting idea. The measurement is a mess. Yes, we can discuss that later, but I'll stop there and give you back the time. Hopefully I haven't exceeded my time quota. And I'm happy to share these slides.
Thank you very much, dear Siva, and thank you for the wisdom, for the ESG wisdom that you shared with us. So now it's another topic. I have some questions on the slides, but I leave the questions at the end. So I think it's better to proceed with our next distinguished executive guest is Mrs. Kathryn Mintoft, EMEA and Head of Sustainability and ESG at Citi. So welcome, Kathryn. Kathryn supporting Citi's priority sustainability commitments and initiatives, including one of trillion sustainable finance goal and the development of Citi's net zero emission by 2050. Has 19 years of experience in sustainable banking, including in both sustainability risk and corporate sustainability at Credit Suisse and Barclays. So Kathryn, the floor is yours to hear your executive, I think, aspect on these issues. And mainly, I'm wondering also for the regulatory aspect, which is very, very important at this stage of ESG status.
Thank you. Good afternoon, everyone. Thank you for the opportunity to join this important and really fascinating conversation. I've learned much in the short amount of time we've been talking. So I'm going to change tack slightly and move from the big picture to give a practitioner's perspective on how we're navigating the challenges of ESG regulation and how we can think about maximizing the value within that. I'm focused on banking, but some of the themes are common across the financial services sector. So I'm part of the sustainability and ESG team at Citi with responsibility for the Europe, Middle East and Africa region. I'm going to talk through some of the advances and challenges of regulation and what this means for sustainability teams trying to implement. I have a couple of slides to share, so just bear with me. Do you see my screen okay? So companies and financial institutions are operating in a complex landscape. Regulation is certainly a driver on ESG risks, but so are investors and employee expectations. And as Professor Rajgopal discussed, we also have the challenge of navigating conflicting views of stakeholders and policymakers in Europe and the US. And increasingly, we're seeing the real world impacts associated with climate change and biodiversity loss materializing. On the other hand, there are great opportunities in sustainable finance. The Inflation Reduction Act in the US being a really good example of where government incentives can drive capital allocation towards sustainable activities. At Citi, we've set out our priorities in our sustainable progress strategy. So on the low carbon transition, as part of our net zero plan, so far we've set targets for 6 of our loan portfolios. That's across energy, power, auto manufacturing, commercial real estate, steel and thermal coal mining. These targets are climate science aligned and consistent with a 1.5 degree pathway. We see opportunity for growth in this transition, and we have a goal to finance and facilitate $1 trillion of sustainable finance by 2030. And we continue to build out our climate and environmental risk capabilities. As an example, last year we finished developing a climate risk management framework, which we're now working to embed into risk management processes across the bank, as well as relevant policies and standards. And finally, we've set out goals for our own operations for 2025. So regulation can be a really powerful tool to mobilize resources and tackle difficult and complex challenges. It can help us provide a common language and frame of reference, which is not only saves us a lot of time, but also is an important foundation for understanding risk and for mobilizing capital. And where have we made progress? Well, firstly, as you would expect in climate risk management, which has been a real key focus for banking supervisors, particularly in the UK and Europe, but managing environmental and social risks is not new to banks. This June marks the 20th anniversary of the Equator Principles, which is a voluntary framework to manage environmental and social risks in project finance. For the companies developing those projects, there are real world risks to the success of their projects, and therefore financial risks to banks, where the banks are lending directly to the projects. But as Andreea mentioned in her opening remarks, banks have needed to move from a use of proceeds approach to an approach to develop an understanding of physical and transition risks at both the corporate and the portfolio levels, partly in response to TCFD and climate-related regulation. This is evolving work, and there is much more to be done. For example, on understanding the interaction between climate transition risks and on physical risks. Secondly, in the area of disclosure, the TCFD recommendations were published back in 2017, and since then corporates have made great advances in describing and to some extent quantifying climate-related risks. There are also very welcome efforts towards harmonisation, such as the ISSB standards, but in order for this to benefit investors who are using this information, we need to collectively support this effort towards a common frame of reference. Finally, there have been important strides in building greater credibility in sustainable finance through developments such as the taxonomies for sustainable activities. These are really incredibly important, but further work is needed to improve the usability of these and to work out how these will work across national borders. So what are the implementation practitioners for, what are the implementation challenges, for practitioners? And I'm just going to mention 4 of them. I can't go any further without talking about data. So there is much said on this topic, but it's particularly true for banks, as there is even less disclosure for private companies than there is for publicly listed companies. So we rely on data that is based on estimated or unverified figures that can make precision difficult and creates challenges right across risk management. So in scenario analysis, setting targets, and particularly for providing clear year-on-year comparisons of data. The emerging disclosure standards will help address this, but regulations such as CSRD are quite broad in nature and cover a wide range of topics and metrics. And it's easy to forget that even the relatively simple disclosure of Scope 1 and 2 greenhouse gas emissions for companies still leaves a company with a lot of methodology choices on how they calculate and report their emissions, which can impact the ease of comparisons. And a study that we conducted back in 2020 found that there are only 3,500 companies globally that are disclosing greenhouse gas emissions at all, and that's after a number of years of companies voluntarily adopting the TCFD framework. So I think there's a case to look in depth at a few of those really key metrics that we expect will become more important in financial decision making, and to really get those right first. A second challenge is the lack of harmonisation between international regulation. We're really enthusiastic supporters of the initiatives that promote a global approach, such as TCFD, the Network for Greening the Financial System, and ISSB. After all, we're a global business, and these are global challenges. For an international business, it's challenging when subsidiaries fall under different regulation in different jurisdictions, because we end up with fragmented metrics at the subsidiary level, which is firstly resource intensive, but sometimes inconsistent with our organizational structure and the business strategy that we need to work with to address these challenges. Another key pitfall can be relying on a tick box approach. And I think there's risk for this in the forthcoming Corporate Sustainability Due Diligence Directive, which will encourage very broad application of due diligence and contractual clauses to try and mitigate risks to the environment and society. But human rights risks are always complex and often have underlying causes such as poverty and social inequality. So for a company to have a positive impact in its value chain requires deep engagement sustained over a period of time to achieve better outcomes for workers and communities, ideally with multiple actors in the value chain focused on the same issues. So we need to ensure that we leave companies the ability to be able to devote resources to focus on outcomes for the longer term. Finally, sustainability is of course complex. This is no surprise to anybody, and there are difficult decisions for governments to make on use of natural resources and a just transition. Developing countries often have limited capacity to transition and frequently lack investment capital necessary to fund adaptation and mitigation. So as we think about our clients' transition plans, we have to be sensitive to both regional context and to social as well as environmental issues. So what does all of this mean for the Chief Sustainability Officer and sustainability teams? Strong foundations are really key, and building capacity is vital. This means not only building up specialist teams in several areas, but also supporting a much wider group of employees in building skills and knowledge. So for example, last year we launched training pilots for our banking and our risk management teams, including virtual and in-person workshops focused on providing foundational knowledge on sustainability, climate risks, and particularly assessment of clients' transition plans to help enable them to have quality conversations with their clients. Data and technology are also a particular challenge. We have to invest in capturing new ESG data and hardwiring that data into multiple systems for multiple uses. But we also need these systems to be flexible enough to cope with rapid change as our understanding of risk and regulations evolve. Reflecting on when I started my career almost 20 years ago, sustainability and CSR teams were pretty much the sole guardians of environmental and social issues within organizations. And today, we need to integrate and operationalize sustainability into every function: credit risk, strategy, product, legal compliance, the list goes on and on. As an example, disclosure is starting to migrate from the CSO, the Chief Sustainability Officer, to the CFO, the Chief Finance Officer, as it becomes integrated into financial statements, although this is a long journey. And we're working on developing data governance and reporting controls to help support that process. Sustainability teams are very used to working by influence rather than by control and by building internal partnerships. And I can't see that changing, but there's also now a huge knowledge transfer challenge. Like, how do we build sustainability knowledge and decision making and translate that into every role in the organization? So I just wanted to briefly reflect on how sustainability teams can make the most of the regulation. Regulation has its advantages. It can level the playing field. But I don't think we should lose sight of some of the advantages we've gained already by acting voluntarily. We can see regulation as an opportunity if we're clear on our purpose. We need to keep asking ourselves, what risk is this action mitigating, or what positive impact are we hoping for? And if we don't fall into the trap of taking compliance as the end goal, which can sometimes happen, but instead take the learning as the end goal and factor that into a cycle of continuous improvement. We need to maintain space for innovation for our bankers who understand their clients and their markets best to innovate and to work on structuring novel financing solutions. And we need people to be engaged and motivated and to want to set ambitious goals for their teams, which relies on creating a culture of excitement and of it being okay to learn by doing. So to summarize, ESG regulation in financial services, and there is a lot of it, is leading organizations to collaborate across functions in new ways. There is much to be gained from this move, but we should not lose sight of the value to our businesses along the way. Thank you.
Thank you very much, Kathryn, for this excellent approach of the regulatory reality, especially in European level. Very, very good approach. I'm wondering also about the harmonization of the ESG regulation, and the question is, what is ESG? Is a regulatory expectation and a regulatory requirement, or a mission for all of us? So this is a question that I think we need to more think about it. Also, a very good suggestion as far as the challenges about the I think, the group risk of ESG, in which also a culture issue is included. Okay, this is my remarks. Okay, the third distinguished speaker of our session is Mrs. Katharina Schwaiger. Okay, Katharina is the head of sustainable research and innovation for factors, sustainability and solution in BlackRock Systematic. Dr. Schwaiger is also the co-head of sustainable investing for BlackRock's multi-asset strategies and solutions team, overseeing the ESG research, integration, and implementation efforts across the whole platform. And prior to joining BlackRock in 2013, Kathryn was worked as a financial engineer in the City of London and also as a lecturer in the London School of Economics. So the floor is yours, Katharina.
You are muted, Katharina. You are muted.
Cannot hear you, Katharina, unfortunately. I think now you are okay. If you can start.
Can you hear me now?
Yes, you can start.
Ah,
yeah.
Perfect. But did you see my slides as well?
Unfortunately, the slides are not here yet. Okay.
Can you see them now?
Yes, now it's okay.
Ah,
yes.
Perfect. So first of all, thank you so much for having me at the panel, and I'm looking forward to the Q&A sessions as well in a few minutes. So I wanted to share also a practitioner perspective, in particular around how one can create Paris-aligned portfolios. So how we want to do that, but also why we want to do that. The effects of decarbonization on portfolios. So as particular, if you want to build a Paris-aligned portfolio, this is going to be a key component. And then finally, I'll talk a bit more about what we call climate-aware alphas. So how can we actually generate excess returns using some of those climate characteristics? So I know we have limited time today, but a lot of the papers or a lot of the topics that I'll be discussing today are published, so you can find more information on all of those topics and papers in greater detail as well. So let me start by just introducing the Paris Agreement, which of course everyone on this call is very familiar with, but we really talk about mainly around we want to limit temperature increase to well below 2 degrees. But actually the Paris Agreement is much more than that. It's additionally to the temperature target also around adaptation. So how can we help in particular the poorer countries to adapt to the adverse effects of climate change? So to speak, we don't want to leave anyone behind. And then finally, the third goal of the Paris Agreement is around flows. It's around directing flows towards climate resilient technologies and those technologies that will help us adapt to climate change. Now, the third point is really interesting and very important for investors because it means if we know where the finance flows will go into, it will create an investment opportunity. And if we can identify winners and losers from the transition, it will be an incredible investment opportunity to all of us. Now, how to really create a portfolio based on the Paris Agreement is probably a question mark, but we have been leaning on two frameworks, one by the EU Technical Expert Group on Sustainable Finance and the IRGCC and the Institutional Investor Group on Climate Change Framework. They are complementary to each other. The EU Tech guidelines is very prescriptive on corporate bonds and equities, listed equities, and the IRGCC framework covers other asset classes such as real estates or sovereign bonds. Now, what they have in common, and that's really important to create a Paris-aligned investment portfolio, is that they use forward-looking data sets. So not only do we want to look at carbon emission intensities of a country or a company as of now, but we want to understand what are their plans going forward, what are their temperature commitments going forward. So we want to understand how much progress they are making towards the transition. The second aspect, and it has sort of been touched upon before a bit, is around sector neutrality. So take, for example, your equity portfolio as of today, remove every energy and materials company in there, and you're going to have a very low carbon emission intensity profile. Now, this is actually not solving the problem, it's masking the problem. So a true Paris-aligned investment portfolio will not divest from entire sectors, but rather it will try to be exposed at a minimum to a high climate impact sector and identify within the sector the winners and the losers of the transition. So it's not an entire divestment strategy. Additionally to that, we want to use more and more data sets. So we've spoken about carbon emission intensities where we want to have scope 1 and 2, but also scope 3 that takes into account the supply chain effects of a company. And finally, which I'll show you a bit more in detail, it's an evolving portfolio. So a Paris-aligned portfolio is not a net zero portfolio as of today. It's a net zero portfolio targeting net zero by 2050. So you need to have gradual progress in the portfolio to be called a Paris-aligned investment portfolio. Now, for equities and corporate bonds, these are the science-based guidelines. I won't spend too much time into them, but it's a combination of risk-oriented and opportunity-oriented guidelines, a combination of minimum baseline screens alongside decarbonization constraints. So we want to have relative decarbonization as well as a self-decarbonization rate, which I'll touch upon about, and then also this forward-lookingness. So we want to understand corporate target settings, the green to brown share ratio, etc., alongside this really important sector constraint of having a minimum exposure to high impact sectors. Now, the decarbonization part is one of the key aspects of a Paris-aligned strategy. And I mentioned to you that it's a gradual evolving portfolio. So we want to have a reduction in our carbonization profile over time, which is illustrated something like this. So if you want to achieve net zero by 2050, you want to see every year a gradual reduction on the portfolio level to guarantee that decarbonization net zero by 2050 target. Now, it is a combination of a relative decarbonization and self-decarbonization rate. Those numbers I'm showing here on the slide with 50 and 7% come from the EU TEG guidelines, but they've also been verified by other bodies, by other academic institutions. But these are the ones that lead to that net zero by 2050 with a base year of 2020. So of course, if you start your portfolio a bit later, you would need to increase those rates to achieve net zero by 2050. But what does this really mean on a portfolio level? So here's a simulated systematic strategy. On the left-hand side, we're comparing the benchmark MSCI World in red to this optimized ESG score portfolio. So really just looking at maximizing ESG scores, and then the optimized version plus exclusionary screens in the green line. Now, the takeaway from the left-hand side is that, yes, at some points in time, your optimized ESG strategy will give you a lower carbon emission intensity profile. So the green line and the yellow line are lower than the red line, but not at all points in time. So actually just looking at ESG scores and just looking at screens will not guarantee a lower carbon emission intensity profile. Now, what's also interesting is if you look at the red line MSCI World as a benchmark, between 2010 and 2015, that intensity profile would have actually increased. So if you had a portfolio with a relative decarbonization rate, yes, you would have looked great on a relative basis versus the benchmark, but you have actually seen your intensity profile increase over the period. To avoid that, we really need to include those decarbonization targets, a combination of relative and self-decarbonization, which is shown on the right-hand side in the sort of rosy pink line. And that's the only way for your portfolio to really be on that gradual pathway of a decarbonization to net zero by 2050. Now, the question we always get asked is, how much does that change your portfolio? What return do you need to give up if you add those constraints in? So we've done a simulation on both the relative decarbonization and self-decarbonization rate, and we measure a change in our objective function or exposure of the original portfolio with respect to all those different relative decarbonization constraints and self-decarbonization rate constraints. Of course, if you constrain your portfolio, you will give up something, but the question is how much? And you'll see on this slide, actually, you don't give up that much. So the information ratios or the Sharpe ratio stays the same. Your change in portfolio exposure doesn't change much. It's actually single digit percentage points. So you can easily bake in those constraints without deviating from your original portfolio and without giving up your returns. The same holds true for the second set of constraints with the self-decarbonization rate, again, varying the different degrees of decarbonization rates on this chart. But again, it's the same message. You're not changing too much of your portfolio, and you can still deliver the same Sharpe ratios as you're used to. Now, the more interesting part for us is how can we actually identify winners and losers of the transition? So how do we identify what we call in this case climate over alphas? We've done more work in sustainability, so also looking to S&G characteristics, but I just wanted to share a few examples in the climate space and why we actually believe it's a source of additional return that we can harvest. The first set is looking at forward-looking data sets, such as the SBTi of the Science-Based Target Initiative. So companies that have set themselves targets are actually outperforming the peers, which you can see on the top right-hand side chart in the green line. Now, why is that the case? And we found a couple of reasons for this. First of all, companies that are on the SBTi are also higher gross profitability companies than their peers. So you are actually seeing on the bottom right-hand side chart in the box and whisker plots that in the yellow, these are the SBTi companies, they are more profitable companies. Now, we also found that SBTi companies are indeed reducing their carbon emission intensities into the future. So not only do they pledge and talk about it, but they do seem to do actually the effort to change their emissions going forward. And we've actually also included as our sort of climate over alpha, just looking at carbon emission intensities. So again, we believe that companies with lower carbon emission intensities outperform their peers that have higher carbon emission intensities. And it's a very intuitive rationale behind it, because if you're good with your resources, you should also be good with your natural resources. So not only do we want to look at financial resources, but also things like carbon emission intensity, water management, waste management. And if you're good in those aspects as well, you are a more profitable company. So it's a very intuitive explanation on why we believe carbon emission intensity companies that are lower in those terms are better than their peers. Of course, companies that are also then playing in the field of innovation, for example, looking at green patents, would outperform their peers. Now, that's probably the purest form where you can think the innovation itself is having sustainable outcome. And it's also a form of innovation and protecting the IP of a company via issuing or granting patents to your innovation. So you're staying ahead of the competition. So patents per se, nothing new. But of course, if we subset it to the green patent space, it's that direct way of influencing the energy transition. And finally, of course, you can extend it to other asset classes as well. a very brief example here is looking at green building certification. Again, those are more efficient buildings, and they're also helping us towards the transition. So in the interest of time, let me just wrap up by saying that as an investor, we believe in something that we call the double bottom line. So we want to find companies that have both a potential to outperform their peers, but they also have this deliberate, sustainable outcome affiliated with that. And to do this, we actually tend to also leverage a lot of alternative data sets to really understand those granular aspects of companies or countries. And with this, I'll pause. Thank you so much.
Thank you very much, Katharina. Very, very interesting. For us as compliance officer, it's very important to understand how much the fluctuation of carbon rate may influence also the fluctuation of our investment capability in a company. It's very, very important as a point. So I think we have finalized our presentation. So we pass now in our Q&A session. We have already a question for Professor Silva. Many proponents of ESG argue that the incorporation of ESG criteria in investor strategy will lead to outperformance. Is this a valid claim, a positive alpha? Is this a valid claim?
Panos, yeah, thank you for that question. Excellent question. I personally don't think so. Why? Let me just clarify. And again, my arguments are mostly US centric. So showing a link between, say, E and alpha is complicated in the US because we don't have a carbon tax. So the people who make these claims have to justify what is the underlying mechanism by which the firm's cash flows change. And if you tell me risk, which is the usual story, I don't know how to verify risk. So I'm a bit skeptical about the idea that E and future cash flows are related. With S, there can be a relation with, say, human capital. Hopefully, we can all agree that by treating people better and getting them more motivated, hopefully, there's more productivity and hence more cash flows. With G, things are complicated because G is arguably the most important of the E and the S and the G. And people who complain about G when stock prices fall, they don't complain about G when stock prices are going up 10, 15% per annum, right? I mean, consider the case of Tesla. If you think it is bad G, and we can have a conversation, the stock prices are insane. So the G, I think we can show a relation between G and cash flows and maybe even some cost of capital stuff, but it's messy, context specific. So when people make claims that ESG leads to better alpha, I encourage people to go look into the data, look into the specifics, and it's more complicated than it sounds. And I think you don't even have to make that case. Let me step back. You don't have to sell that ESG leads to alpha. If you look at my last slide, there are fundamental questions about what a company does in society. Some of it is a philosophical moral debate. It doesn't even have to be super economic, frankly. Would be one comeback.
Thank you very much. Another question for Katharina. The estimation of alpha crucially depends on the risk factors one controls for. If one omits certain factors like quality and volatility, then an ESG alpha may come up. In this case, an ESG alpha exists simply because one did not control for the right risk factors in the benchmark model. If the right factors are incorporated, then ESG alpha will go away. In other words, ESG alpha is just a reflection of well-known firms' characteristics. What is your view on this, Katharina?
Yeah, thank you so much for the question. So if you just take smart beta ETFs, for example, and you look at the minimum volatility ETF or the quality ETF, yes, they will have a higher ESG score than the benchmark, and they will have a lower carbon emission intensity profile than the benchmark. So there's definitely a positive relationship. However, we do believe that you can actually define factor definitions themselves using sustainability data sets. So, for example, I showed you a signal that looks at carbon emission intensity. To us, this is a quality signal. So similar to how we think about traditional quality as anti-leverage, profitability, some form of cash flow metric, we believe that actually looking at some of those climate characteristics is also a form of quality characteristics. And that's really going back to the economic rationale. So is it because of a risk premium argument, a behavioral bias, or a structural impediment? On those sustainability characteristics can also lean on those economic rationale. And we also find that these signals are additive to your traditional factor exposure. So you're not just doubling down on the same characteristic, but you're actually measuring something additive to this. And to give you an example, you could think of value, look at your normal traditional book to price type value, but you can also look at intangibles, which will include green patterns. Now, these are complementary aspects of a company that we want to understand. So for us, it's more about using sustainability data sets to express factor definitions themselves.
Very nice. Thank you. Thank you very much for the answer. I have a question also to Kathryn, concerning the main issue of the harmonization of ESG regulation. I would like your approach, I think, Kathryn, especially if you see a great risk if in case that the fully harmonized regulation may impact on ESG innovation. Okay, what I think do you think on that? You think that there is a risk of reduction to ESG innovation in case that in several years we all I think will be under a very strict and also harmonized regulation?
I think there are, as I mentioned, I think there are real benefits in standardizing regulatory approaches. But that is one of my concerns. I would like to think that regulation in itself doesn't stifle innovation. Innovation is driven by client demand and by competitive pressures to seize the opportunities. And I believe that's a really very important piece of the puzzle here. What I do think there's a risk of is, regulation and compliance takes up a lot of resource. And so the slight danger is that the resource gets directed towards compliance and doesn't leave so much space for innovation and also the ability to get things wrong. So I think that's something that we as sustainability professionals have to think about carefully, and to think about how we balance this kind of dual approach of, yes, we want a standardized approach that gives our investors decision useful information, but also we need to serve our clients at the end of the day. We need to innovate to try and mobilize sustainable finance capital.
Thank you very much. I think that we are close to close this session. So I think that we are coming out of the session much wiser. Thank you very much, all of you, for your participation. And I give the floor to the Professor Skiadopoulos with many, many thanks for this honor. Thank you very much.
Thank you, Mr. Dasmanoglou, and thank all three speakers for the very insightful comments, presentations, and discussion. And thanks to the audience. May I bring you some good news? I've just been informed that we enjoy a very big audience today, an international audience. So we have more than 900 people who have registered from all over the world. So congratulations once again.